We'll get rolling.
Yeah, thanks, Tim. Appreciate everybody joining us tonight for Proactive Year in Tax Planning 2024. This is our second iteration of this presentation. Was really well received around this time last year. So Tim and the team thought it'd be a great opportunity for us to spin this up again, especially post-election season. There's a lot of change potentially on the horizon. So we're going to go over some strategies tonight that could benefit you if we do some proactive planning. But before we jump in, we have to share some fun words from the lawyers if you want to jump ahead to that slide. Everybody's favorite part.
Yeah,
Here's our fun
my dad likes to read that stuff, so
we'll stay on this as long as possible. But essentially, what this says is tonight is about information and not specific advice. For Tim and anybody at Dyer Wealth Management to give you specific advice, he needs to have a full understanding of your specific situation, which we primarily can determine through a one-on-one conversation. So again, tonight is not about advice; it is about information. If you do want to chat with Tim and the team, we'll have an opportunity at the end of tonight's presentation for you to set up a one-on-one conversation.
all right, I can take it from here, Zach, and we'll kind of get rolling.
Yep.
So, hey, look, why should you be listening to me? Well, I've spent my life's work talking about the things that we're going to talk about tonight. You can see from the video feed that I don't look like that airbrush picture that's been around forever. But no, I've been quoted in various publications and different sources. I've got a podcast called the Retirement Power Play podcast.com. I mentioned that because those are just areas where you can get additional resources about the things that we're going to talk about tonight. So, I'll just jump in here. We've got a lot going on. 2024 has been a heck of a year. I mean, we're just coming off the election, and some big things have happened there. But one of the things that we can't ignore, no matter what, the results or how you feel about the results of the election, is the stock market as we know it is doing extremely well. This is a chart just of 2024, and you can see, and we're using the S&P 500, which is a common benchmark for that we use to kind of test the health and strength of the markets. And you can see up 25% for the year. So things are going well, and along with that, those gains in the market potentially comes some tax liability. So we're going to dive into a couple of things as it relates to stocks and other types of planning issues. This is recorded. You guys will get a recording of this. So I'm going to move pretty quickly through these things so that, we're not having a breakfast over the finale, but we'll keep moving. All right. So after we look at stocks, we might be thinking, well, we've had a good year, but we might be up for a decline or something of that nature. I'm just going to grab my highlighter here. How do stocks perform after up years? Since 1928, I kind of drew a line through it, but 1928 to 2003, when we've had a positive year, the next year of the stock market, historically on average has been up about 11%. Now, I mentioned the market was up 25%, this year. When we've had a gain of 25%, the average return the next year is 8%. So this trend can persist. Okay. Again, these are good things to have, but we want to make sure that your investments, we've got a full sale out there right now, or full tailwind. We want to make sure those sales are definitely open and taking advantage of that. But like I said before, we certainly want to make sure that we're managing the tax bite, because as our friend Robert Kiyosaki says, it's not how much money you make, but it's how much money you keep. Not bad advice for the rich dad, poor dad. But we're going to, and some of the things that we'll cover tonight are going to go over methods of how we can keep more money put in your pocket. Now, I want to pause here for a second, and I'm sharing some fun pictures of my family here. But the big picture around all of these things is we're not out to save money in taxes or make smart decisions with our money just for the sake of it. It's not ye at the end of the game with the most money wins, right? It's so that we can enjoy, have a life of significance and spend more time with the people that we love and do the things and have the experiences that we want. Now, money is a tool that allows us to do that, right? Whether it's spending time with family, kids, or grandkids and whatnot. My son Luke there, who turned 6 this week, he's there in the spacesuit, and then my son Easton is the one on the right, my wife Tara in the middle. but we do this hard work and we put in the work so that we can do these fun adventures and experiences and spend time with the people we love. It's not the other way around. It's not, we don't do this just to save money. Okay, so I've beaten the point there. So let's move on. How do we have success with tax planning? And really, we do that by having a proactive approach. Okay. Now, the inverse of that certainly would be a reactive approach. But just you being on here tonight tells me that there's something that you'd like to learn, because it's important for you to make smart decisions with your money so you can do the things that you want to do. There's over 10,000 pages, or I should say there's tens of thousands of pages in the tax code. And you can't assume that anybody has read it all, right? Because that's not the case. But inside the tax code, there's sticks and carrots, as I say. There's a lot of sticks, but there's some carrots in there. And every person is different, and which carrots work for them to help them, have a better tax or a lower tax liability. All right, I gotta just clarify something. This is very important. A lot of times when we talk to clients or prospective clients, or people in general, they say, well, how come my CPA hasn't told me about this? Or how come, or my CPA takes care of that. I want to be very clear. We work with CPAs on a daily basis. They're very knowledgeable on their craft, but what most people are getting from their tax person is tax preparation, right? And tax preparation is essentially, the scorecard, if you will, from the year before. So our tax year is going to close December 31st, 2024, and everything that happened during this year, the CPA is going to kind of add it up, subtract it out, and you're going to get a number. Tax planning is the opposite, right? It's looking forward and saying, hey, here's some things, some milestones on the horizon. It could be a job change. It could be buying or selling a house. It could be selling stock that's highly appreciated. I mean, there's a lot of things that impact the income that you have. And tax planning is forward-looking. So if you think about, tax preparation is sort of like looking back, and it's the story of the last year. And tax planning is essentially like writing the story with your, desired ending, if you will. So I just want to be clear, the difference between tax preparation and tax planning. Last thing on this sort of foundational, my friend Carl Richards, he drew this skit up for the New York Times. I always thought it was a great one. There's the taxes that you pay, and then there's the taxes that you could have paid. And the difference between that is the planning or lack of planning in this case that affects you. So we want to be thinking about some of the things we're going to talk about tonight going into year end, but we also want to be thinking about things as we go into the new year of what could affect your tax bill, because it's always going to be better to prepare ahead of time. All right, the current landscape. This is, there's a lot to talk about with the election and whatnot, but I want to just simplify from a tax perspective. When we think about taxes, whether it's in investments and whatnot, we really when we make decisions, we break them down into three categories. And we're talking about the federal tax brackets here. The first one is the 10% and the 12% bracket. And I'll show you here in a minute, like what income levels are in the 10% bracket and the 12% bracket. But here's a simple way to think of it. If your income falls in one of those two brackets, when you make a decision that has, or when you come upon making a decision that has tax implications, you need to consider it, but you can probably just go ahead and do it. You're just not going to find a lower tax rate around that, because those are the lowest tax rates. Conversely, when you sit in the 22 or 24% tax bracket, these are things where you should just run some calculations. Hey, if we did it this way, it'd be that. If we did it that way, it'd be that. And you might see a big difference between some of those calculations, right? And we'll look at like a Roth conversion calculation. We'll take a look at some other things that, depending on where you are, you're kind of on the middle of the fence. You get in that third bracket or third bucket, of those federal tax brackets, 32, 35, and 37%, you're really tax sensitive, right? These are big checks that get written when, if you were to buy or sell a house or buy or sell stock or sell a company or just simple things. So you want to be running all those calculations, especially in a tax sensitive world. So now you might think, well, 32, 35, 37, I've got it in red. Like that's the top of the tax bracket, right? But that leads me into this next slide. This is the historical top tax bracket. Okay. And let me see if I can grab my highlighter here. Right here, we saw taxes were 90% at the highest rate. And there's an interesting story about there that when Ronald Reagan was making movies, he would only make one movie a year because he made so much money that between federal and his California tax, he actually lost money, right? And so he would only do one movie to keep him underneath that, 90% bracket. It's crazy. So we're a long way from that. But the environment that we've been in, we have context over the last, 40 or 50 years of kind of this 40%, 50% range, right? That green line is the middle range at 63%. Tax rates could go a lot higher and still be within a normal range. Makes sense? We going at an okay pace here? Thumbs up, everybody. All right, cool. All right, so here's a crazy slide. Don't worry, you don't need to zoom in on it. You might want to write this down. Maybe Zach can put it in the chat here, but the usdebtclock.org. You want to see something that'll keep you up at night. This is basically the tally of our national debt, all the state, things, a bunch of other statistics. But let me zoom in on one. The U.S. national debt right here, I kind of highlighted 23 trillion. Now you might say, well, wait a minute, that number sounds familiar. Well, it is, because that is the number that it was last year when we did this talk. Okay. This year it's 35 trillion. So, I'm okay at math, but 35 minus what, 20, 23, 12 trillion in 11 months. It's a lot of money. That's a lot of money. Okay. Now, we don't need to take national debt down to zero. It's not like a loan that comes due, right? But what's important about that is if you look on the bottom right of this slide, okay, right here, our debt to GDP is about 122%, which basically means, if you made $100,000 of income, you've got $122,000 of debt, right? And so typically, we've had debt numbers, but they've been a smaller percentage of GDP. And GDP is, just think of that like the economic pie, right? That's getting bigger and bigger every year, but the debt that's going along with that is just growing at a more exponential rate. So what does that really mean? Well, we've got two ways to kind of solve that or bring that ratio down a little bit. We can cut spending or we can raise taxes, right? So now you kind of see where this is leading. I mean, we've got historical rates that have been as high as 90%. Right now we're at, 37% on the high end. We could see those shift. Now, if we had talked the beginning of the year, kind of before we got well into the election, that blue route would have been out the window. Like, no way, we're not going to see any government cut spending, anything. But maybe there is some of that that's on the horizon, and that's not a bad thing, right? Who was it? Elon Musk got elected to the what is it? The DOGE, DOGE, the Department of Government Efficiency. I don't know. I mean, maybe he cut some departments, and that can kind of help on some things. But those are the only two ways that the debt gets solved. And so we may see a combination of the two. Hey, we're going to cut some of these government departments, but hey, we're going to see some tax rates on this side. All right. So let's talk about some planning considerations and some strategies. I'm going to try to frame it through the different types of income that we see. So Let's dig in here. Now, in 2017, Trump, he cut tax rates under the, they call it the TCJA, which is the Tax Cuts and Job Act. It was a significant reform that came in, and it did a couple of things. Now, the items that we see on the slide now, I'll kind of go through these along with some other bullets in some of the other slides, but it reset the ordinary income tax rates. It reset the capital gains rates, which are now 0, 15, and 20%. But more importantly, it raised the standard deduction. Okay, and it pretty much doubled them. They move every year with a little bit of inflation. But the standard deduction is really in place so that the federal government doesn't tax every single dime that we have in some way, shape, or form. So as a married couple, you get to deduct $29,200 just right off the bat. Okay. If you're single, that's $14,650 for 2024. Now, in a few years, at the end of 2025, these tax cuts are set to sunset back to where they were in 2016 before Trump cut the tax cuts. Now, he may extend those, and that's a good thing. It gives more time to, do things or maneuver money around at lower tax rates. But that's going to take legislative approval. And, again, you've got a House, the White House, the Senate, and the Congress are all lined up. So that may help, but you never know. They still got to get these laws passed. The SALT deduction, what we're talking about there is the state and local tax. So if you have $20,000 of federal tax and $10,000 of state tax, you can only deduct $10,000. That came down under the Trump cuts. That used to be unlimited. The mortgage interest deduction, that's another one that came down. You used to be able to deduct a lot more of the interest on your home mortgage expense. Okay. And there's some other things there. So these are kind of the key elements around the tax structure that we're in now for this year and for next year. And then they change and they get a little worse. So we'll look at that too. All right. So there's really two types of income, and I've got those on the left. There's ordinary income and there's capital gain income. The little bucket on the top left, it shows W-2 income, so that's wages, salary. 1099 is dividends and interest, your Social Security payments, and short-term capital gains. What that means is any asset that is bought and sold in under a year. Okay, that falls as ordinary income. Again, we're going to talk about that more here in a second. But if we take a look at this bucket, we need to think about all these sources for each person out there. You might have one of these sources. You might have multiple of these sources. So for everybody, it's different. But this is the stuff that's taxed at those ordinary income rates. And let's take a look at those. All right, 2024, there are 7 tax rates from 10% to 37%. In 2 years, those rates automatically sunset back to the 2016 rates, which are 10% to 39%. Now, I'll just kind of say a side note here. We typically see, sorry, I lost my train of thought there. All right. Oh, when people talk about the rates, a lot of times they're talking about the brackets as well, right? So what money is taxed at 10%? What money is taxed at 12%, et cetera, et cetera. But the 10% would be the rate, and then the bracket around that, what money's charged, is called the tax bracket. So that's just a little language clarification. Let me show you what it looks like. Inside this red box, we've got the different layers of income. Now, the US tax code is what we call a progressive tax. When you fill up each bucket, which is designated by those dotted lines, okay, as you fill up those buckets, is that on the slide or is that? Okay. So from 0 to 22,000, that is taxed at 10%. From $22,001 up to $89,450, that's taxed at the 12% rate. Okay, and then from 89,450 up to 190, that's taxed at 22. The key here, and the thing that I just want to make very clear is, once you go into a new bracket, it does not poison that money in the buckets below it. Okay, everybody got that? Make sense? Thumbs up. All right, so let's take a look. I'm going to take us to a projection here. This on the left side under 2024, this is the tax rates and the brackets for each rate. So if we take, I think in our example, we took a $200,000 earner. We know that $22,000 on the left gets filled up at the 10%, up to 89,000 at the 12%. I just went through this before, but now that 200,000, you're just a little bit into that 22% bracket. Okay. If you look at the mountain there, the pyramid on the right, it's that same trajectory, but you'll notice all the way to the right, the rates are higher. I think I put an arrow here, and the brackets are lower, right? So I did that backwards, but the brackets are lower and the rates are higher. So you blast through that first 10% bracket now at 18,000, not at 22,000. 75,000 versus 89,000. So here's where it looks. If I just put a little red line here. Let's just say that your income was 200,000. Remember how we said you're just kind of snugly in the 22% bracket on the current 2024 rates? Well, in 2 years, you're going to be snugly into that 25 and almost into the 28% bracket. And that's a big change, right? And think about that. That's just, 1 year. Tax rates could go up. Your income could go up. This could happen for 20 years in a row. So those little changes kind of start to add up. So we want to be mindful of the income that we receive, right? Where we get it from. Now, all of these things can't be controlled. If your boss gives you a good raise, terrific. If you're your own boss and you create more value at your company, terrific. Your wages are going up, but now you're just having a conversation about, say 35% bracket versus 28 versus 22 versus 15, you see? So you can just see in this example, bottom line is in 2 years, you're not only going to pay higher rates, but you're going to accelerate through those brackets faster. And therefore, it may make some sense to do it always makes some sense to do tax planning, but it may make some sense to bring some income into this year, whether it's selling stock early or a variety of different things, and paying in what's known to be a lower rate. Let me just check in here. Okay. All right. So somebody, I think Ian had mentioned something in the chat room. I just checked on the standard deduction. The numbers that we were looking at are that numbers get applied to that grid after the standard deduction. We talked about that a little bit ago, but when we talk about the standard deduction, we're talking about that free deduction that the IRS gives you. Single, it's $14,650. Married, it's $29,200. Here's the thing. Before the Trump tax cuts, a lot of people would itemize their deductions. And what that means is, instead of just taking the flat rate of $29,200, for example, they would add up all of their expenses that they could deduct, and it added up to more than what the standard deduction was back then, because it was significantly lower. In fact, for married filing jointly, it was closer to what it is for a single filer now. So it was easy to surpass the standard deduction when you itemized. With the Trump tax cuts, the standard deductions essentially got doubled. And now I think it's close to 90% of all taxpayers just pay or just use the standard deduction. Okay. Now, why does that matter? Why are you telling me this? Well, because there are some things that you may be paying for, or maybe some charitable things that you may be paying for, that don't necessarily get the credit or the tax deduction applied, because it just all falls under the standard deduction. You're no worse off, but if you're not getting the tax benefit of, say, that charitable donation. So I'm going to show you one of my little 5-star tips here, which is how you could potentially get around that. Now, I'm just going to use this example, use a round number. Let's say you are making a gift to a charity of $10,000. It's a lot of money, but let's just say $10,000, and you plan to do that over the next 3 years. Okay. Now, again, let's just say you're married, so that we know the standard deduction is 29,000. It moves every year, but $29,000. So if you have a $10,000 charitable deduction, that's less than $29,000. There's a few other things you can add on top of that: your mortgage interest, your state and local tax, but you're probably it's going to be probably pretty close. And that's with a fairly big charitable gift, right? What you can do is you can use something called a donor advised fund. And instead of making a $10,000 payment every year for 3 years, you can bring that money into a donor advised fund, and you can take that $30,000 deduction this year. Okay. Now, you take that $30,000 deduction. Now you start for the charity, which you do all in 1 year, and then you add your mortgage deduction, state and local tax. Now you're starting to get $40,000, $50,000. That's more than the standard deduction. Hey, that's lowering your income. So it's just one way with just doing some shifting. And by the way, I'll make a note: with a donor advised fund, and any major company like Fidelity or Schwab, they can help you out with these things. But and we can help you out with that as well. But you can have the donor advised fund give money to any charity you want, and you could have it paid over 3 years. And so that cadence is still the same, but you get that deduction all in the first year. So 5-star tip if you're out there, working with gifts and things like that. So let's take a look here. Move on here. So now we're going to talk about the second part of income, which is capital gains. Okay. Capital gains is a tax on any profit that you make from the sale of a capital asset, such as property or, your stocks, mutual funds, your investment portfolio. And the thing to know is that those tax rates are different than the ordinary income tax rates. Okay. And I've got those right here. It's either 0, 15%, or 20%. All right. Now, what percent you pay for capital gains is determined on what your income is. Okay. So if you're, let's just say, between 94,000 and 583,000 as a married filing jointly, this pen isn't very big. I should probably grab a different color. If we're looking at this bucket, for example, then you're paying 15% capital gains tax instead of maybe 22, 24, 33%. Now, you don't have to necessarily you don't have to sell stock just because you pay 15%. But at the same time, you might sell stock because you only have to pay 15%. Capital gains rates can change. In fact, how do I say this? The runner-up in the last election wanted to eliminate capital gains and charge unrealized gains and turn it into all into ordinary income. But the thing to think about is, if you're in a scenario where your income, maybe you've got a large bonus, maybe you hit the lottery. I mean, it could be a variety of different things. But if something changed your income, you may want to defer and take those capital gains next year. You only got to wait 45 days to get past December 31st, and you're in a whole nother tax cycle. Conversely, if you had, for example, maybe a job loss or some kind of large medical expense, maybe your income is artificially compressed this year. You can then, bring in some income or sell off some assets if need be. And you could do it and in some cases you could do it for zero tax because you're not over that 94,000 limit if you're married filing jointly. Or even if you are, you're probably into just the 15%. I hope you have the problem of paying 20% because you've got $600,000 of income and gain, but it is what it is. Okay. I want to talk about a couple of specific strategies here. And this one I think is one of the best strategies that is constantly overlooked. Okay. And a lot of times by do-it-yourself investors, or maybe somebody that's not getting a second set of eyes on things. Tax loss harvesting, really, it's selling a stock at a loss to offset future gains. Okay. Now, it might be capital gains that have already been realized in this year. It might be capital gains that come in the future. Okay. But remember, we said that ordinary income and capital gains are taxed differently. That's correct. But there's a key fact here that if you take a loss on an investment, you can actually take $3,000 of that and reduce your income by that amount. Not a ton of money, but hey, it saves you a couple of bucks. The money that you don't use to reduce your income is used to offset other gains. Okay. So if you sold shares of NVIDIA this year because it did really great and you had a big profit in it, but then you sold some shares of something that didn't do as great, you'd have to look pretty hard this year to find some of those names. But that you can use that as a netting effect to keep your capital gains exposure potentially down to zero. Let me give you an example. So let's just say you had $100,000 in a stock, okay? And that stock declined at some point during the year. You have a $70,000, it's now valued at $70,000. And you could sell that stock and take a realized loss of $30,000. Now, you might say, well, if you sell the stock, what happens if the stock recovers? Well, one of the rules of tax loss harvesting is you can sell and buy something right away. It just has to be something different. Now, what's different? Well, it could be another stock. Different is different. And I'll give you an example. Let's say that $100,000 was in Pepsi stock. It drops down to 70,000. You could sell that Pepsi stock and immediately buy Coca-Cola stock. Move kind of similar. And we have tools that allow us to find assets that are very similar. But you get the picture. If Coke does well, Pepsi's probably going to do pretty well. And you still get that recovery. So your 70,000 can go right back to 100,000. But that $30,000 that you've got is now, it's like in an escrow account, a virtual tank, if you will, and it allows you to offset future ordinary income as well as $27,000 of capital gains, either this year or in the future. Okay. I put a little note there about to avoid the wash rule. What the wash rule is you can't sell Coca-Cola and 2 days later buy Coca-Cola back. You have to wait 31 days if you actually want to buy the same security back. But if I zoom out for a second, and we were talking at the beginning, the top of the hour, we were talking about how the stock market's done really well this year. So a lot of these things are up, right? In 2022, we had that negative year. Plus, during COVID in 2020, we had that really dramatic drop, 30% in a month. But those situations are where you can actively take advantage of these things and start moving things sideways, building up all these, these taxable losses while still maintaining full investment. And then as you have future gains, you don't have to pay taxes on it because you're just using that escrow account to do it. So anyways, I hope that one was helpful. We use that a lot. And in this environment where stocks have done so well, we actually have the opportunity to do tax gain harvesting. And that's sort of the inverse of that. What we mean by that is you have stocks that have got really big gains. I know the market probably will continue with momentum into next year. We'll see. But some of these losses from before, or when we look at your tax brackets, maybe peeling some of those off at these lower rates here might make some sense and redeploy them. Maybe top off the emergency account or take that big vacation you'd be thinking of. So there's tax loss harvesting in down markets, and there's tax gain harvesting in strong up markets to allow you to rebalance. All right, that second Starbucks is kicking in here. I got a little energy. On the screen, I just have an example this is actually a recent example. So on the top right here, if I grab my red marker, you can see that the client's got $100,000 of unrealized gains in the account, but down here, these little red, I mean, they're not huge losses, but there's some stocks maybe that were bought recently that have red around that have losses. We could sell those stocks and then use it to offset some of the gains that might be incurred by selling these ones that have profits. Okay, so this is something that we do. If you want us or someone on our team, we can take a look at your positions. We do this for all our clients as we come into year end. But take a look at those positions. You can pull them up on your account and just say, hey, what have I realized in gains this year? Is there anything out there that I could just sell? Maybe there's a couple of dogs that you've been holding on to. Might be time to old yellow those, and then move on with maybe a better position. All right, that's our tax loss harvesting. So when we think about some of the additional tax planning strategies, we got to think about some of the foundational activities like retirement savings, okay? The reason I have these buckets over here is these buckets of money have a different income or a different income profile. So a tax deferred bucket, those are your IRAs and your 401ks, your TSPs if you're a government employee, et cetera. The money that goes in those, they grow every year, tax deferred. But when they come out of that bucket, they're going up and over that black line into the ordinary income bucket, and you're paying taxes on them. Okay. We'll talk about the Roth bucket here in a second. But for 2024, you can put in up to $23,000 in your 401k. I recommend you do so. If you're over 50, you can put in an additional $7,500. And you can see as well the simple IRA and the SEP IRA have contribution limits and catch-up provisions if you're over 50. One thing I'll put out there too, and not a lot of people are aware of, if you work for a major corporation, one of the things that you want to look for, the annual limit on contributions is actually $69,000. Okay. The amount you can put into a 401k is $23,000, but there's something called an after-tax account that you can put in the difference between your 401k contribution and that 69,000. So what's that, 46,000? That number does come down a little bit because a lot of companies, they match your contribution. With that being said, you can kind of roughly say you could put another $35,000, $40,000 into an account. That typically is at the large employers, but something to be aware of. That is called a mega backdoor Roth IRA. Mega backdoor Roth is what it's called. Okay. Any chance you get an opportunity to say mega, you just got to do that, All right. Now on the personal side, outside of the business contributions, you've got IRAs. That just simply stands for individual retirement account. Okay. A traditional IRA, as long as you have $7,000 of income, you can put $7,000 into an IRA. If you're over 50, you can put in another 1,000 for a total of 8. Same thing with the Roth. Now, the traditional IRA, you pay tax on, or you're funding it with after-tax dollars, and it grows tax deferred. The Roth IRA, it grows tax deferred, but it also comes out tax free. I'm going to show you how you can get money in there. We just got to look at these limits here real quickly. If you're a single filer, I'm looking down at the green check mark down here. You're a single filer and you make less than $77,000. That's AGI. You can deduct that $7,000 that you contribute in there. If you're married and you make under $116,000, you can deduct it, right? So it's a nice little perk. Make sure that you're doing that if you can. If you're over that, you can still contribute it. You just can't deduct it. Now we come over to the Roth. This is kind of the inverse scenario. If you make less than 138, you can contribute directly to a Roth as a single filer. If you're married filing jointly and your joint income is 218, you can contribute the $7,000, right? So, if you don't qualify for the traditional IRA deduction, you may not qualify for Roth contribution limit. But wait, even though it says you're not eligible, there's a way to do it, and that's through a backdoor contribution. Now, I know we're going everywhere pretty quickly here. Let me just show this visually what that means. If your income isn't high enough where you can deduct it, just do it. Just if you're below that threshold, you can do a deductible traditional IRA, go there. But if you're over that, but you're over the limit to contribute directly to a Roth IRA, what you can do is what's called a backdoor Roth IRA contribution. And in this case, you take $7,000 or $8,000 if you're over 50. You contribute it into a traditional IRA account, and then immediately convert it or roll it over into a Roth IRA. Because that $7,000 is after-tax dollars, okay, the conversion amount is untaxed, right? Now, if you put it in and you fell asleep at the wheel and you came back 2 months later and that $7,000 was $8,000 or something, and you rolled it over, $7,000 would roll over, and the $1,000 you'd have to pay taxes on to get it in there. But then it's in that Roth bucket and to the moon. It's never going to be taxed again, okay? Barring a legislative meltdown. But usually these things get grandfathered in if something like that happens. Does everybody understand? Is that clear how you can get money into these? A lot of times I hear from people, oh, I make too much money. I can't contribute to a Roth. Yes, you can, and I'll show you how. All right, and that's how you do it. So now we come to my favorite bucket. You'll notice it also has the least amount of inputs around it, right? The tax-free bucket is the Roth IRA and the 401k. There's some cash value life insurance options that's a little more complex, but let's keep it simple here and say that to get money on that tax-free highway, at somewhere along the way, we got to pay the toll to get in that bucket. But then from there, it grows completely tax-free, okay? So on the one hand, we talked about making a contribution to a Roth IRA through the backdoor conversion, the backdoor Roth. What I'm thinking about here with this goldfish picture is you may have money in an IRA now. Maybe you have a rollover from an old company 401k. Maybe you've been contributing to an IRA over years, or a combination of the two, and you've combined them into account. You want to do some year-end planning that says, hey, it might make sense to take a piece of that or the entire amount or some combination and move that from the tax later account, which is the goldfish account, into the Roth IRA account. Now that little fish there that's flying high, in order to get in that Roth IRA bucket, he's got to pay the tax while he's up in the air there, right? So then we go back. Remember we looked at that pyramid of the brackets? We just say, okay, how much income do we have? I'll show you. I think I got the graphic here. The top horizontal line would be just the tax exposure, an example of $100,000 of income. We know that you filled up the 10% bucket. You filled up the 12% bucket, and you're just lightly into the 22% bucket. And I would argue if you had money in an IRA, I would fill up that 22% bucket. Take some money from that IRA, convert it into a Roth, right? I think, you'd have, what do we say, about $80,000, $90,000 you could put into that and still be in that 22% bucket, okay? But here's something else to think about, everybody. 24% isn't that much higher than 22%. Right. And for people that are, at or near retirement, you may have a really large 401k by now, potentially. And so I would argue 22 and 24% isn't a big difference. That 22% tax bracket is going to be 25 in just 2 years. I don't know. Might make some sense to unburden that money from future tax liability and convert all the way up to the 22% bracket and maybe into the 24% bracket. It takes a calculation. That's something that we can help you with if that's a scenario for you. But I just want you to be thinking, you're always filling up buckets, but you can control to a certain degree how much you fill them up. And do you want to fill them up now at known rates or later at potentially higher rates? That's kind of the bigger takeaways. Couple of quick ones here, then we'll bring it home. Health savings account. Everybody that's on a health plan, I want you to log into your online portal tomorrow, or I want you to log into your HR, and you can find out if HSA is available. Typically, it's available for something that's called a high deductible plan. And a lot of the plans out there are high deductible. But when you have a high deductible plan, then they let you set up this HSA. And what's important about that? Well, the money that you put in is pre-tax. You get a deduction for that contribution. That money grows tax deferred. And when it comes out for qualified medical expenses, it's tax free. Now, I know people that have been doing this for years. And keep in mind, the HSA account, it's like an investment account. You can set it up at Schwab or Fidelity or a lot of different places. You can invest it in whatever you want. There's no handcuffs. You don't have to put in CDs or money market, right? But people are using this almost like a jumbo Roth, right? And you can use it along the way and take money out if you need, you want to pay co-pays or medical co-pays or something. But a lot of people are using this and they're getting, over the years, 50, 100. I've seen even higher balances. And that's money that can compound 10, 20, 30 years, depending on your age. For you younger people out there listening, hey, start filling those up. Then you don't have to worry about healthcare expenses in retirement. It'll all be tax-free. All right, take a quick second here. Shirley had asked a while back, sorry, I missed that one, about the wash rule for mutual funds. Okay, kind of the same thing. Mutual funds, you might have a fund family like Fidelity or Vanguard. They've got mutual funds, and you might be in a specific mutual fund that's, say, the large company fund, and you might sell that and buy the international fund. Those are two different funds, even though the name on the fund label is still Fidelity or Vanguard. So that's a good question. You would have to buy the exact same fund for that to be a wash rule. Okay. Now, one thing to be careful of, we were talking about the S&P 500 at the beginning. If you buy the S&P 500 and you buy the index, let's say SPY is the ticker symbol, and you sell that, and then you go and buy the Vanguard S&P index, which is VOO, that's materially the same thing traditionally, right? I mean, I think that one's cutting it a little close. It's the S&P 500, and it's the same type of investment. So, all right, I'll keep moving on. Got a couple other things. Gifting. I saw a scenario the other day. A client of mine was getting to put an offer in on their first house, and really excited about it. And in order to avoid PMI, which is mortgage insurance, you need to put down 20% down. They were a little light. So they had actually gone to parents and grandparents and whatnot and put together a little bit of money as a gift, which got them over that 20% threshold and reduced their PMI, which, again, that could have been $400 or $500 a month, right? It's a pretty big number. But as it comes to tax strategies, anybody can gift $18,000 to anybody without any tax consequences. All right, I'll say that again. Anybody can give anybody $18,000. Now, what happens if it's more than that? Well, what happens is you have to file a gift tax return or a form on your tax return, and then your lifetime gift amount just gets reduced. Now, we're going to look at a second. That's a really big number of what that lifetime gift tax amount is, but something to think about is if you have children or grandchildren, you might gift, grandma gives grandson $18,000, grandpa gives grandson $18,000. January 1 comes around, it's a new year, grandma and grandpa each give $18,000. Now it's kind of an extreme example, right? That's a lot of money. I think that's what, $72,000, 36 times 2. But it's a way to lower the estate, to give money without taxes, The family gets to sort of enjoy it together while, you know, everybody's still alive and whatnot. And that kind of contributes to that fulfillment and that kind of life of significance. Um, Ian asked if you give the gift back to them. Now, if somebody gives you $18,000 and you give them back $15,000, it's sort of like two separate transactions, right? It doesn't like wash itself out. One other thing that comes to mind is if I give $18,000 to person A, that's not my annual limit. That's just your annual limit to that person. You can give $18,000 to your neighbor and $18,000 to Tim Dyer for being a good guy. You can give $18,000 to your charity, whatever it might be. So that could be unlimited amount. That's what I have to say about the gift tax. The lifetime exclusion. This, again, I know we're getting kind of long here and there's a lot of numbers, but with the cuts, the estate tax exemption amount went to 13.6 million. Now, it started at like 12 million. It goes up for inflation. So this year it's 13.6 million. That's per person. So anybody that has an estate tax problem, which would be, you know, what, 30 million roughly, you know, just send me a note after this and we'll talk. Because the money after that, over and above that, gets taxed at 40%. In 2 years, that goes down to 6 million per person, and it gets taxed at 45%. So thinking about some wealth transfer in the next couple of years, you know, if that applies, makes sense. When I started in the business in 1998, that amount was $675,000. It was a lot of money too. Oh, how times have changed. Okay, bringing it home here, 529 college plans. If you can get money into if you have young children or grandchildren, you can gift money into a 529 plan. That money grows tax-free. It grows tax-deferred, essentially tax-free. And then when it comes out for higher education expenses, it comes out tax-free as well. Really powerful tool. Some people might say, well, what if my kid gets a scholarship like I thought I would and didn't? Or, you know, an academic scholarship, I never thought I would get that, and I didn't. But consider this. You open up a 529 and you fund it for 10 years, okay, a number of periods. At a 7% interest rate, using that $18,000 gift amount, just as an example. That compounds out over 10 years at $260,000. Now, I put in the red there what it costs per, you know, what it costs on average for a tuition, college tuition. And that covers that amount. But it doesn't just end there. If you do get that scholarship, academic, athletic, grant, whatever it is, and you don't use these funds, it's not like it's lost. In fact, it's quite the opposite. New legislation has said that you can now take that money and convert it into a Roth IRA. Now, there's certain limits on how much you can do, but you know, let's just say it's $35,000 or $50,000. That money continues to grow completely tax-free. So you've got somebody that's 22 coming out of college. They've got some extra money in there. They've got it into the 529, which didn't have any limits like a Roth does. Then it converts over to a Roth and then grows for, you know, 40 years, something like that. That's over $6 million. Somebody has tax-free at retirement, you know? So it's a vehicle to help pay for college expenses. But if anybody has young kids, and it takes 15 years to be allowed to convert it to a Roth. So take a note on this one. If you have kids or grandkids, I want you to set up a 529 account, put $100 in there, and get that clock rolling. Everybody will be in better shape for that. Charitable distributions. If you're over 70 and a half and you're gifting money to charity, do not gift it from your taxable account. Gift it from your IRA. You can gift up to $105,000 without tax. Okay. So that means you can take money out of that tax deferred bucket, which usually gets taxed at ordinary income, and you can get it tax free. So they call it a QCD, qualified charitable distribution, often overlooked strategy. All right, just a couple of last things. We talked about a lot of the foundational tax ideas and tax strategies. getting the retirement accounts funded. Make sure you're doing the gifting. 529s, bracket management, filling up your brackets, your tax brackets, tax loss harvesting, those types of things. The next level are what I call advanced strategies. Now, I'm not going to go into details on these because they may or may not apply. Everybody's situation is unique, okay? But there are things, if you're a big real estate owner, a cost segregation study could be a massive tax saving opportunity, okay? If you have adjusted gross income over 300,000 or more, you could look at either solar benefits, oil and gas, or financed equipment leasing is something that's very popular right now, where you can get a massive deduction off your adjusted gross income for an investment in it's essentially using what's called accelerated depreciation. So these are some things, if you want to have a conversation about them, I'm happy to chat about them. But let's just bring the last part home. In summary, we talked about these things today. All the aspects of foundational tax saving opportunities. The clock is ticking between now and the end of the year. And once that year happens, you got another year of planning, but that window closes. So it's important to make sure that you're getting a lot of these things done, get all the I's dotted, T's crossed, make sure the portfolios are set up for, what probably could be another very solid year next year. And, less tax, more growth, and more time and fun and experiences with your loved ones. That would be considered a success. Zach, I can just bring this up to you here if you can see the screen, but we have a specific tax report. We run a tax analysis on everybody's tax return that it's almost like running a comb through your hair and just making sure all the deductions that you can take have been addressed, all the strategies have been tested against your income, and that you've really got it down where you've paid your fair share of taxes, but you haven't left the tip. We'll send the link out for this as well. I hope this was helpful. We'll send this link if you're still with us, and